Welcome back. Meta, the company behind Facebook and Instagram, has announced another round of layoffs. It plans to shed 10,000 jobs only months after cutting its workforce by 11,000 workers. That came in November. For more of what this means to the tech sector, plus some insight on what the failure of that bank in California means to tech companies right here in Canada, let's bring in Bruce Croxon. He's co-founder of Round 13 Capital. Bruce, lots to talk about. Let's jump in, first of all, with SVB. What are you hearing about the failure of that bank and the Canadian early stage tech sector, in addition to perhaps having a broadly negative effect on sentiment? SVB did have a branch here in Toronto. It didn't take deposits, but it was a lender to the Canadian tech sector.
Yeah, Paul, they tried for years to break into the market here to do what candidly, the existing Big Five banks have done very, very well in Canada, which is to support early stage technology businesses that in years gone past would never have gotten a sniff of a senior secured loan because of their lack of EBITDA and just sort of the overall riskiness of the sector. It is a very good business because of the reliability of the top line revenue of some of these companies. But as you can see, by the SVB failure, there is also, it still does play in the riskier section of alternative assets. So interestingly enough, as you can imagine, it was quite a wild weekend last weekend when the bank went down. Before it sunk in that, this is going to fall into the too big to fail category, and the government didn't want that ripple effect going through other banks and people losing confidence in banks in general. People were scrambling around trying to make payroll, and we were no different, even though we're a Canadian company and very well supported by the likes of Bank of Nova Scotia and others. We did have some exposure to Silicon Valley Bank. So like everyone else, we were scrambling around. Cooler heads prevailed. We sort of predicted that, it was going to be bailed out. And so we're back to, up here in Canada, I would say we're back to business as usual. And in fact, just before coming on, I put a call into David Rosen at Bank of Nova Scotia and just said, listen, now that the smoke has cleared, is there any change over at Bank of Nova Scotia based on, a ripple effect up into Canada of SVB's troubles? And he was very quick to reassure me and don't mind, I'm sure he's talking to everybody, saying, listen, we still think it's a great category to support. If anything, we're going to double down to make up for any deficiencies that SVB or problems that SVB may have caused some of your investees up here. You can count on us. We like the business. So once again, right, I keep saying that Canada is one of the best places in the world to grow a technology business, not the least of which reason is that we complained in the past about how much power the banks have here. But as far as technology in this generation goes, they have been extremely supportive, and I would put it as one of the main reasons Canada is still one of the best places to grow a tech business.
Okay, that's a great insider's view of the SVB situation and Canada's tech sector. We would not get that from anybody else but Bruce Croxon. Thanks, Bruce. Let's pivot now to Meta. You've got Meta's in the news again. It is shedding employees again. Another 10,000, regrettably, will go. You've got some thoughts, and we've got a couple of graphs that we can show our viewers on employment growth at Meta over the past decade or so and revenue growth over the past decade or so. So here's the first one. It's up on the screen now. We're showing our viewers the total number of Meta employees from 2010 to 2022. It's staggering. It goes from a number well below 10,000 in 2010 to a number well above 80,000 in 2022. Now we'll show viewers another graph. This is the percentage change in revenue on a year-over-year revenue growth on a quarterly basis. So each bar represents a quarter of revenue. And what it measures is the revenue growth, or indeed the revenue declines by those tiny red bars at the right side of the graph versus the same quarter a year earlier. And you can see very graphically here, the trend over that period of time has been downward. Bruce?
Yes. So, and that leads quite conveniently to a metric we often use in our industry called revenue per employee. And obviously by that chart, as the number of employees goes up and the revenue goes down, the revenue per employee declines as well. Now, all that's fine and good in a time where revenues are up to the right. There's lots of money around. Money's cheap, right? I'm hearkening back to over a year ago. People are, willing to pay 2% interest to take a bet on the metaverse and support Zuckerberg's grandiose plans to massively spend on R&D on what he thinks is going to be the next big thing. There's a tolerance for that. But when interest rates goes up, money shrinks, Silicon Valley Bank goes under, people get a little nervous. The stock market hasn't done well. NASDAQ's gone south. Things change, right? And investors demand something, and the market tells you we're no longer willing to support spending without results, or a revenue per employee chart that's headed dramatically the wrong way. Now, I will remind you that every time you flip on a news feed, you're seeing talk of different layoffs in the tech sector. I'm going to divide it quickly into two sections. One is massive ramp up of employees before the pandemic. Business was great, money was cheap, and then, okay, tighten it up. And that downsizing or right sizing generally hasn't come anywhere near to the amount of employees that have been hired over the last decade. So let's not overreact. The second category is, yes, you've got that at work, but in the case of Meta, you also they've been under big pressure because it's tougher to target advertising. TikTok's kicking their ass. Business is slowed because of the economy. So they've got a bunch of other factors that have necessitated what could be viewed as a deeper cut than the rest of the technology sector.
Is it not destabilizing to a big company's business to let go of so many employees? I mean, it begs the question, what were those 10,000 employees doing if they can all be let go today?
Paul, it's always the same, right? I mean, from my operating days, I remember we sold Lavalife, one of the first dating sites in the world, to a U.S. public company. And, every time we had to meet the quarter, the first thing to get cut was the Lavalife media budget at a time when we should have been spending. And then next it was when they had to meet the quarter. Bruce, you have to get, instead of the 600 employees you're going to have to make do with 450. And you know what's funny? What happens is you realize how much those 450 people can really do. And the CEOs push and scratch and claw, and we can't possibly get it done with 450, but it's amazing in good times how fat companies become. And believe me, if you hire people, they will fill their day. But the question is, it doesn't always line up with what the priorities of the company are, and you'd be amazed how much you can get done with less. And I think maybe Elon Musk might have something to say about that as well, in how he's stripped Twitter of a massive number of employees, but yet I'm still getting my Twitter feed. I'm not using it quite as much, but that's for a different reason. But it's still functioning and still doing what it's supposed to do. So, I've seen this story before. We get fat in good times. People will fill their day, and then there is a right number that you can still do very well. And I think the market rewarded Facebook on both occasions when they cut the number of people because they believe it too.